Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share simple, easy to understand, evidence-based, holistic insights to help you master the game of building wealth. I paused a little bit there in the intro. I almost forgot what my goal was. As always, I encourage people to send in your questions. Try and make them as general as possible. I can't give you personal advice, of course, but just send any questions to questions@investopoly.com.au and I'll certainly get to them. I think I might do another Q&A episode instead of a case study episode next week, and I'm going to try and get through as many of these questions as possible. In fact, I'm going to get through all of the questions. So if you send it in, I will reply and answer. Okay, so let's get into today's topic. And today's topic are 6 important considerations when selling a property. It's not an uncommon situation where clients will go and sell a home or go and sell an investment property. And it's a common conversation that we have with clients regarding this. And of course, the goal is to maximize the sale price always. And what are some of the things that you need to think about in order to do that? So a bit of a lighter topic this week. We've had a couple of heavy ones in the last couple of weeks. And then, of course, I'll get to some listener questions at the end. Looking forward to doing that. Maybe I shouldn't say this, but I'm really surprised at how good the questions are. I find them really interesting. I hope you do too. So please keep them coming in. Okay, so let's get back into the episode. It's 6 important considerations. The first one that I want to talk about is presentation and improvements. How you present a property is probably that, and choosing the right real estate agent to sell it. They're the two sort of critical decisions, if you like. And there's that saying, you only get one chance to make a first impression. It is so true with property. And a lot of people inspect property will only see problems or sometimes are looking for problems. Secondly, other times people will be really focused on, do they like the property? How does the property make them feel? The really subjective or emotional considerations and how a property is presented can make or break that sort of first impression, how people kind of feel about a particular property. Now, of course, what you're trying to do is eliminate objections. There's no perfect property. Normally, people are going to have some objections. There's one or two things that I don't really like, but you're trying to minimize them as much as possible. You're trying to create a lot of demand. So you want people to inspect the property, even if they're not necessarily interested buyers. It will just create this feeling that the property is in demand. And for those that are genuinely interested in buying it, that's going to put a little bit of pressure on them. And then hopefully you want someone to fall in love with the property. If you can sell to an owner occupier, they're going to be potentially more emotional buyers, whereas investors are really just focused on the numbers. So if you can sell to an owner occupier, that's really kind of your goal, because if you get someone to fall in love with it, maybe they'll pay a little bit extra in order to buy it. Now, also, when you go and sell a property, the last thing you want to do is sink some money into it with respect to, making improvements, renovations, repairs, those sorts of things. However, not doing those things can actually harm you. So really what you want to do is make whatever cosmetic enhancements are necessary to achieve the highest price, but nothing more than that. And typically it's going to be really cosmetic things like maybe a coat of paint, changing floor coverings, those sorts of things that are going to really have a significant impact on how the property presents, but a relatively low cost, relative to, the potential sales price. Now, sometimes if you go and ask a real estate agent, what should I do? Then they might reel off, look, if you can do all these things, it's going to make my job a lot easier. It's not really the question you want answered. You want what is going to give me the highest return for my investment. So if I spend $20,000, will it get me another 100? If it does, it's a no-brainer. Sometimes getting a vendor advocate to help you with those decisions, which I'll come to in a second, can be beneficial. And the last thing I want to talk about is property staging. So that's really when a professional comes in to really enhance the property's appeal. That can include furnishing a vacant property. It could be rearranging existing furniture, highlighting key areas or features, or even neutralizing decor so that, it's not vanilla, but it has sort of wide appeal. Staging can be one of those costs that is easily avoidable. It's easy to say no to staging, but I think it's like the icing on the cake, if you like, in many situations. Having a property well staged and well presented, again, is going going to give you the greatest opportunity to achieve the highest sale price as quick as possible. I'm not saying you want to sell it overnight, but you don't want that property to be stagnant on the market for 2 or 3 months just because it's not presented as well as it could have. That's just going to make it stagnant, and it's certainly not going to probably achieve the highest sales price. So before contemplating selling a property, they're the things you need to think about. How am I going to present this property? Are there any improvements that I need to make? Do I want to stage it? Those sorts of things. The second key consideration is the best time to sell. Now, the general wisdom out there is spring is the best market. The weather's a little bit better. People are more willing to go outside. When it's raining and cold, of course, no one wants to go and randomly inspect a property, but it's not too hot like it can be in summer in some locations. And gardens look a little bit better. They've had the winter rain, so they look pretty lush and, the foliage is coming out. So in terms of presentation, often spring can be, the sort of period of the year that people divert to in order to sell their property. But of course, during spring, you're going to face more competition as well. Listings typically increase during spring, and sometimes you've got more competition, maybe the same number of buyers, and you end up in a potentially oversupplied market. Whereas winter has less competition and in some areas statistically can achieve better prices. But also you need to consider your property's characteristics. When is the best time to sell? So if your property, has limited natural light, maybe summer sort of showcases the property a little bit better. Conversely, if your property's, prone to overheating, it gets really warm during summer, well, maybe winter's a better time to sell. Of course, location can matter too. Coastal properties tend to be better off to sell them in summer, while everyone's down the coast, enjoying the benefits of that location. If you're in northern Australia, late spring can be problematic. Sometimes it's, rainy season, cyclones, higher humidity, these sorts of things. I guess you've got to think about, when is the best time to sell given your market, given the property's location and its characteristics. Don't all automatically assume necessarily that spring is going to be the best time. Okay, consideration number 3 is who and how to sell it. I think this, as well as the first one in terms of presentation, are easily the most important. Choosing the right real estate agent, as I said, is really critical in this regard. In a perfect market with a perfect property, you don't need a great agent. The property will sell itself. But the reality is there's no perfect property. Every property has some shortcomings, and markets, they might start off being perfect. They might not end up being perfect during the sales campaign. And so you need to select an agent that has, a strong reputation in markets, extensive experience in operating in different markets. You want someone with a really good and large network. That's why you want someone that's been in the market for a long period of time. They would have built up a database of, of contacts to obviously help them sell these properties. Of course, you want someone with excellent sales skills and, dare I say it, a good character. Of course, there's dodgy real estate agents out there, but there are some great real estate agents out there that just genuinely want to do a great job, want to build trust and rapport with their clients, and as a result, they kind of keep the bullshitting to a minimum. Excuse my French there. And really, the key aspect here is when things don't go to plan. When things don't go to plan, you're going to really rely on the agent's skill and knowledge. If everything goes to plan, then again, it's one of those situations where the property sells itself is less important, but you just don't know if it's going to go to plan or not at the beginning, of course. Now, many buyer's agent firms these days offer a vendor advocacy service, often at no additional cost to the person. They tend to split the commission with the sales agent. A vendor advocate's going to help with crucial decisions like when to sell, what sales method to use, auction, private sale, expression of interest, or something else, which agent to choose, most importantly. And I think there's a lot of value in them also advising on what improvements to make to the property. I say that because a vendor advocate's going to have a little bit more independence than an agent. It's not necessarily their core business service. So, they don't necessarily, unlike agents, they need listings and they need sales to keep their cash flow going and their business going. So you go and ask an agent, when's the best time to sell my property? They're going to say tomorrow, normally, or at least that's the risk in the back of your mind is thinking, well, do they just want to sell it tomorrow just because they need the sales revenue? Whereas it tends to be an adjunct service for buyer's agents. And so they don't really care if you sell tomorrow or the best time is actually to sell early next year. They're going to tend to tell you that. Also, particularly if you've got a strong relationship with that buyer's agent, maybe if they've bought properties for you before, you've built trust and rapport rapport with them, it goes a long way. I think the vendor advocacy service, I'm saying this from a personal experience and also professional experience, really makes a huge difference. They sort of insulate you to some degree from having to deal with the agent, and they're going to monitor the campaign throughout to make sure the agent is doing everything they need to do, given the market conditions, given the feedback from potential purchasers of the property, to ensure that they're taking every step to maximise your sale price. Now, if your property is currently tenanted, to my mind, it makes sense to inquire whether the tenant is a potential purchaser before you even maybe approach a selling agent or a vendor advocate. And you could do that through the managing agent. They can just speak to the tenant. If so, it might be a nice and easy way and quicker way in order to sell that property. The fourth consideration is taxation. So, of course, if your property is being tenanted during any period ownership, you might be liable for capital gains tax. Essentially, the capital gains tax liability is really the difference between the property's cost base and its net sale proceeds. So, what you sell it for less any selling costs. And you can tend to divide that number by 2 and multiply it by your marginal tax rate. And so that could be divided by 2 times by 47% being the highest marginal tax rate, depending on what your other income is. If the property became your main residence as soon as you bought it, so you move straight in, well, then the cost base will be its market value when it first became available to rent. So if you bought a property and then 4 years later decide to move out and rent it, well, it's the market value at that 4-year time that becomes the cost base. If the property was rented out immediately after you purchased it, so it was an investment property right from the beginning, then the cost base will be the purchase price and stamp duties and any purchase costs. And whatever, if you lived in that property during that period, you might get a partial main residence exemption, and that'll be prorated based on the number of days you lived in the property versus the number of days you rented it out. And of course, there's that 6-year rule that covers the situation where you rent out your main residence for up to 6 years and don't claim another main residence. You can potentially continue to claim that main residence exemption for that 6-year period. I've got a link in the blog on the website. It's a bit confusing, but I think the key thing here is, make sure you understand the taxation liabilities associated with selling your property. Of course, speak to your tax agent in that regard. And then also that as a result of finding that information out, you can work out, is there a particular financial year that you're better off selling in? So for example, a common one is, well, why sell the property while you're working? If you're close to retirement, maybe delay selling the property and sell it in retirement if you expect to have a significantly low taxable income at that stage of life. The next consideration is to have a think about how your mortgages are secured. So you might be looking to sell the property because you want to use some of that equity in another way. So either to reduce debt or to contribute towards something else. And so it makes sense that you want to have as much control over the sale funds as possible. So in order to do that, before you sell, you've got to consider untangling any cross-securitized loans. So cross-securitization occurs where a loan is secured by multiple properties. So for example, if your investment property loan is secured by both the investment property and your home, in that situation, the bank can force you to repay other loans, loans other than those that are directly related to the property that you're selling, because they hold the other property as security for those loans. So whereas what you'd like is whatever loans that you intend to repay are solely secured by that property that you're selling, and all remaining loans that use other properties as security. That way, all you must repay are those loans that are secured by that property, and then you can control the residual sale funds thereafter. So if I've confused you there, the answer is speak to a good mortgage broker to make sure your loans are structured in a way that's going to give you full control over the sales funds. In fact, you might have alternative security that you can use, and that might give you the flexibility to have access to all sale funds. But again, speak to a good mortgage broker in regards to that. In terms of tax deductibility of any residual debt, well, the tax rules say that once you sell an asset, you've got to use all the sale proceeds to repay any related debt. If there's money left over, well, then of course then you can do whatever you want with it. If the sale proceeds aren't enough to repay all the debt and there's residual debt, it's most likely that debt will continue to be tax deductible. But if you're in that situation, just make sure it's really clean and clear in terms of audit trail. And again, speak to your mortgage broker and tax agent to make sure that's going to be the case. The final consideration is if you're selling an investment property and there's a tenant in it. You may not be aware, but there's a lot of jurisdictions now that require landlords to give their tenants up to 90 days notice before selling. So it's not like you can turn around, say this time of year in July, early August, and say, I'm going to sell in spring market. You've kind of missed the boat already. So you need to work out, it depends on what state. It could be 60, 90 days, whatever it might be. But it just means that if your tenant is under a month-by-month arrangement, you've got to give them plenty of notice. If it's a fixed-term lease, then of course you tend to have to wait for that fixed-term tenancy to expire before you can then give the tenant notice to move them out so you can sell the property vacant. Of course, 60 or 70% of buyers tend to be owner-occupiers. So typically, it's best to sell it without a tenant in there because obviously you're exposing the property to the broader market, that is owner-occupiers and investors. If you're absolutely confident the potential purchaser is going to be an investor, well, then it might not be necessary to get rid of the tenant, although I'd just be a bit cautious about that. That would be an uncommon situation. So there you go. Just to recap, the 6 factors are, the presentation and improvements to the property that you need to make, the time of year that you sell that property, who and how, and again, you use to sell the property, again, using a vendor's advocate makes a lot of sense in a lot of situations. Taxation considerations, understand, what tax you might need to pay, make sure your mortgages are structured correctly, and lastly, if there's a tenant in the property, realize that you're going to need to give them plenty of notice. Now, of course, there could be other factors that you need to consider. These are just very general, but I thought a good sort of discussion or checklist to really think about in case you are contemplating of selling a property. Okay, as promised, let's get into some listener questions. The first one is from Adam. He says, thanks so much for the effort you put into the podcast. My pleasure, Adam. I do put a lot of energy into it, but I do enjoy it, and I'm glad that you enjoy it too. Anyway, Adam goes on. He goes, my name is Adam. I'm from Perth. I've got 5 residential properties, including 4 investments and 1 owner-occupied property. Well done, Adam. 4 properties are in Perth and 1 in Brisbane. The total value of the portfolio is $3.8 million with an LVR of 55%. My goal is $200,000 of passive income. He goes on, here's my question for you. I've heard you discuss buying residential property for capital growth to build the asset base as leverage and then get into more liquid assets like shares. Yet I don't hear you talk too much about commercial properties. I see shares as capital growth and income producing and liquid. I see commercial property as income producing. Are there general stages when you should use shares over commercial property and vice versa? When is a good time to switch focus from residential to shares and or commercial property? Is there a value of residential property combined with an LVR that you would think of switching or focusing to achieve my aim of $200,000 of passive income? By the way, my age is 36. Thought this might be important. It sort of is, Adam. Thank you so much for your question. It's a really good one. Firstly, I did a podcast, a 2-part episode on investing in commercial property on the 1st and the 8th of February 2022. So it's a couple of years ago now. I talked about investing in commercial property in detail and how to go about doing that and the pros and cons of commercial versus other asset classes. As I said, it was a 2-part sort of series. So if you're interested, go and have a look at that. There's a couple of sort of comments I would make to answer Adam's question. The first one is, if you want $200,000 of living expenses, you don't necessarily need to have $200,000 of investment income. In fact, that would be a silly way to think of it because you're going to skew towards too many assets that are income style assets, and as a result, inflation might eat away at your capital asset base. The better way to think about it, and I sort of spoke about it a little bit in terms of the super episode I did a couple of weeks ago when I talked about having a perpetual portfolio. So really what you want to do is, if you're saying, well, I'm going to spend 200 grand, then what you really want is that your investment returns being capital growth and income using conservative assumptions assumptions are going to be more than 200,000. Let's say 300 would be great, because that way, if you're only spending 2 of the 300,000 in returns, your capital asset base is going to compound over time. And that was the sort of conversation around perpetual portfolios. So skewing towards income, yes, it's important at some point, but the benefit of shares really is liquidity, because that means that even if I have a portfolio of $6 million that's only generating $100,000 of income, if that $6 million is in the share market, I can sell 100 grand of shares to top myself up to 200,000 if that's what I'm going to spend each year, knowing that, I'm obviously earning my return on the $6 million is pretty strong, right? So that's kind of the benefit of having a combination of assets that are illiquid, so property, and assets that are liquid. The second thing I would mention is the property versus shares. And when I say property, I would say residential or commercial property. As I've spoken about in this podcast a few times, it's not really property versus shares, it's gearing versus no gearing. The reason that gearing works so well with residential property is that you get the negative gearing benefits because the income is relatively low. In return for accepting a relatively low net income, net of expenses, you're getting a much higher capital growth rate, and as a result, that capital growth rate compounds. Whereas your overlay borrowing to invest in commercial property, unfortunately, gives you too higher income, and as a result of achieving a higher income, you are naturally going to achieve a lower capital growth. If you think you can get the same, that is a high income and a high growth asset, that can be a bit risky to make that assumption, because if I'm getting a 6% yield and then I think it's going to grow at 6%, that means I'm assuming my return's 12%. Well, it's probably not going to be 12% over the long run, because I think that's pretty aggressive in terms of an assumption. I mean, it might be, you might do incredibly well, but it's unlikely, and I wouldn't be developing a strategy on it. So I like commercial property. I've invested in commercial property. My wife and I owned a commercial property for about 12 years. We sold it a couple of years ago. We enjoyed tremendous growth from it. It grew at more than 9% per annum over that 12-year period. So it did incredibly well. I think I'd be attracted to commercial property. I sort of said this in the blog in 22. Again, in the future, if I thought that not only could I buy an income stream, but also that the asset value had a lot of upside as well. I don't think that's true at the moment with prices. And commercial property is more cyclical than residential. Residential, most people are occupying it, either renting or owning. They need it. It's a necessity. Commercial property moves more in line with the vagaries of the economy. So if we get a slowdown, even a recession or something like that, maybe commercial property values come off a little bit, particularly like the smaller end, and start to become more attractive. If they start to sell at yields of 6, 7, 8% in good quality prime areas, that could be a signal that they're undervalued and you get in there. But so I'm not against it. And if, I've got clients that invest in commercial property, of course, but you want to have a pretty significant asset base before you started to think about that. And residential property, just because of its attributes in terms of low income, high growth, just suit someone in their 30s much better than what commercial property does. But great question, Adam, and thanks very much for sending in. Okay, Rob's the next question. So Rob's question, he says, is strategically about balancing superannuation balances between a couple. He says they're on track to having a goal of having $3.8 million in super combined by their early 60s. He says, who knows what could change over the next 25 years. So I take it then that Rob is in his mid-30s. Sorry, in fact, he goes on to say, my wife and I are in our mid-30s. I should have read the question properly, Stuart. And she's largely a stay-at-home and works under her own ABN while I'm employed and receive superannuation guarantee. And his superannuation guarantee is more than the concessional contribution limit. Her super is about 60,000, whereas his is 260. While we already use the tax incentivized means to increase her balance, so that includes co-contributions and spouse contributions, it would be great to hear your thoughts on working strategically to start to even up the balances of our super using concessional contributions. And by that he means contribution splitting, which I'll get to in a second, while still maximising the benefits of being able to use carried forward contributions, so that is keeping total super balances below 500,000. Rob goes on to say, in my mind, it doesn't really matter whether I exceed the 500,000 total super balances. I have no carried forward concessional contributions. My wife has the majority of hers, and while it's unlikely she'll have a capital gains tax event in the foreseeable future, the potential for her to salary sacrifice into her super and make use of a carry forward cap might be useful. Accordingly, I'm thinking the best approach would be to leave contribution splitting alone until her super balances was 500,000. So great question, Rob. And for those that are a little bit confused by the question, each person can have up to $1.9 million in super that's going to be completely tax-free. That's called the transfer balance cap, and that's indexed, I think, to the wage inflation rate. So that's going to go up each year. So by the time Rob gets to 60 in 25 years' time, that transfer balance cap, that 1.9 per person, is probably going to be much higher, although who knows, because the government loves to change the rules all the time. And so therefore, a perfect situation would be each spouse has 1.9, because that way you absolutely maximize that tax-free cap limit. But of course, as Rob's alluded to, his wife's not earning as much income as he is, and so the balances are going to be uneven. So what you're able to do then is do contribution splitting between spouses, which allows you to move 85% of your concessional contributions into your spouse's account. 85% because you need to provide for the 15% contribution tax that you must pay in your account. And so what Rob could do is move all these contributions into her account and try and even up their balances, and that's what he's sort of asking about. The other element to this is the $500,000 total super balance, which is the cutoff. If your balance is less than $500,000 on 1 July, you can access any unused concessional contribution caps going back 5 years. But if your balance is over $500,000 on 1 July, then you can't do that. So therefore, for those people that have just ticked over $500,000 in terms of balance in July, or they think they will at some point this financial year, this year could be the last year in which you can use the unused concessional caps going back 5 years. See, that's something you want to think about. So it's a bit confusing, right? Sometimes these super rules make my head explode. Anyway, let's get back to Rob's question, which is really about contribution splitting and when should I even up balances between spouses. The thing we've got to realize is that it takes a long time to get from zero to $500,000 in terms of super balances, and the average Australian's not going to get there. So I'm just really talking about, higher income earners, certainly people in Rob's situation. But once you get to 500,000, the compounding really takes over. Your contributions into your balance start to become less material. And so what I find is it could take people 20 years of their working to get to 500,000. It'll take another sort of 7, 8, 9 years to get to $1 million. It'll typically take 6 or 7 or 8 years to get to $2 million. So it really does compound very quickly. So Rob, if you don't start contribution splitting soon, you may never be able to equalize balances because your balance will continue to rise so significantly. If you leave it for, another 10 years, you're probably not going to get there. Having said that, you don't need a perfect balance by the time you get to 60, because what you could do is start what's called a transition to retirement pension. Even if you're working beyond 60, you can do this, which means that you can withdraw up to 10% of your balance, and then you can recontribute that into your wife's account through making a non-concessional contribution. You can't do that with a normal pension, because once you do that with a normal pension, you trigger your transfer balance cap in that particular financial year. But also, who knows whether that's going to be around in 25 years, right? So wouldn't necessarily be relying upon it either. So I would say that if your strategy is premised on the idea that you're going to have 3.8, circa $4 million in super by the time you're 60, and that's going to be one of the main ways that you're going to fund retirement, I would probably start contribution splitting now. And then when your wife got close to 500,000, I would make sure either 1 or 2 years prior that you would position yourself to utilize any unused concessional caps that she's got. And hopefully you can do that kind of as much as possible now. Also, you might want to investigate whether your employer would be happy to only contribute the cap into your super, which is obviously $30,000 this year, and then give you the remaining amount as salary. And then you could use that amount to make concessional contributions for your wife. But it's a great question. And the answer would be to really financially model it. So get a spreadsheet and work out, well, when do I need to start contribution splitting in order to try and equalize balances? My gut feeling is you need to do that soon, but I haven't ran the spreadsheet. But there's some of the things that I would think about. Okay, conscious of time today and going a bit longer than usual, but the last question is from Dave. And it's a really good one. They're all good ones, as I said. Okay, Dave says, I'm a long-term listener and follow follower of your work. On a few occasions, I've heard you summarize the evidence showing that, over long term, passive share investing strategies outperform active. This aligns with advice I've read and heard from other sources too. However, I've also regularly hear you recommend what sounds like quasi-active approaches to ETF investing, such as your recent blog on 11th of July, where you noted 4 alternative indexing strategies, and several other blogs where you've talked about overweighting geographical markets that are considered to be undervalued. My question is as follows. To what extent is there a wealth of evidence that is showing a relative risk return of these quasi-active approaches over long term compared to a more traditional market cap ETF investing? Dave, that's a really great question and one that I've thought deeply about. And I watched a interview of Jack Bogle. Unfortunately, he died in 2019, so it was a few years before he passed. And similar question was put to him, and he was, the founder of Vanguard, really invented traditional market cap indexing. And the journalist said to him, "Look, here's some shortcomings. What do you say?" And he said, "Yeah, traditional market cap indexing isn't perfect, but it has beaten, most other participants in the market." And so I certainly acknowledge that. I guess if we have a think about, what do active funds look like? What are some of the common characteristics? Firstly, they're opinion based. If I'm an active manager, I'm investing basing on a certain methodology, but it's quite opinion based. I'm going to take a view or a position on what the US might do over the next 10 years, or what an industry might be doing, or, what some new technology is going to contribute towards the market. But it is opinion based. Secondly, they tend to have a lot of concentration risk, and they probably should too. There's a lot of funds called high conviction funds, which might only have 20 stocks in them. To my mind, if you're going to back a active fund manager, why would you want them to pick 100 stocks? Just pick the 20 that you think are by and far the best. Surely that's a better strategy. But either way, one of the reasons they don't really work is that they have a lot of concentration risk, either because they don't have enough individual stocks in them, or they're skewing towards a particular sector. And lastly, they have high fees, north of 1% per annum typically, sometimes 2% per annum. Put all those things together, that's why they don't really work. And when you look at all the evidence. Whereas factor investing, whether it's a quality overlay, sort of a dimensional style investing, those sorts of things I spoke about on that podcast 11 July, they're still cheap. They're very cost effective, mostly less than 0.3, some charge up to 0.4%, but they're still really cheap relative to active. They're very well diversified. Dimensional will have 3,000 stocks in their global fund, so very well diversified. And they try to make sure, a lot of these funds, or at least the methodologies that I talk about, they're trying to make sure that from a sector perspective and a geographical perspective, they're not skewing too far away from traditional market cap indexing, the makeup of that index. So they're not being too active in terms of tilting towards a particular industry and so forth. And whilst they do use a different methodology for working out how to spread the money across the index, it's still rules-based. It's not opinion-based. So it's quite distinct. What it might look like or feel like or sound like it's active, it's quite distinct from active funds management. But you asked about evidence, so let's look at that. Some of these, I acknowledge, some of these factor-based strategies haven't been around for that long, maybe 10 years. Some of them a little bit shorter than 10 years, but a lot of them sort of 10 years. Dimensional's been around since the mid-80s, so that's got a long track record. And if you have a look at the evidence, the outperformance relative to traditional market cap indexing is somewhere in the range of 1 to 4%, depending on the strategy, depending on the time period that you're looking at. But there certainly is evidence of outperformance. One of the benefits of using a rules-based strategy is that you can backtest it. You can ask yourself, well, if I had have invested in this manner using the statistical approach, how would have it worked out? You've got to be careful there. You can't believe every single back test you read. You've got to make sure that the strategy is implementable, and you can implement that strategy with low trading costs, because if the trading costs are very high or it's too hard to manipulate it, then it's a theoretical index rather than a practical one. But a good one is like equal weight, for example. Equal weight index is very implementable. You're just buying one 500th of the S&P 500 into each company. And S&P have been tracking equal weight versus market cap for, I think, 100 years, right? So the data's there. There's heaps of data there. So great question, though. Really good question. Something that I've thought deeply about. And I think the answer is that it might feel like active, but as long as we're low cost, we're diversified, we're not skewing too far away from the general makeup of the broad index, and we're using a rules-based approach, I'm confident it's not active. As I said, some great questions there. Keep them coming. I've got heaps to get through. I will get through them all. And until next week, bye for now.